Welcome to the Explainer. So, you've got these massive global corporations, right? Have you ever stopped to wonder how they actually keep track of their most valuable physical assets? I'm talking about the sprawling factories, the towering skyscrapers, the heavy machinery that literally makes the global economy run. How do businesses account for these massive investments in a way that's fair, transparent, and totally consistent across the globe? Well, that is exactly the challenge solved by the rules of International Accounting Standard 16, or IAS 16. Today, we're going to completely decode this standard by following the entire life cycle of a physical asset.
I mean, to really grasp why this matters, think about it. How do you actually put a price tag on a factory? Or, to use the analogy we'll be tracking throughout this whole explainer, how do you account for a commercial airline buying a brand new multi-million-dollar jumbo jet? Look, without standardized rules, we'd have absolute financial chaos. Companies could just kind of make up the value of their assets, sweeping expenses under the rug or artificially inflating their worth just to trick investors. IAS 16 completely prevents that chaos by laying out strict, logical rules for literally every single phase of an asset's life.
So here is our roadmap for today. 1. What counts as PPE? 2. Calculating the initial cost. 3. Cost versus revaluation models. 4. The rules of depreciation. And finally, 5. Derecognition and disclosures. Let's dive right in.
What counts as PP? Defining property, plant, and equipment.
Okay, when we talk about property, plant, and equipment, we mean tangible items, meaning stuff you can physically touch. They have to be held for use in the production or supply of goods or services, maybe for rental to others, or just for administrative purposes. And crucially, they must be expected to be used for more than one single accounting period. But wait, just meeting that definition isn't quite enough. The core recognition principle here is super strict. An item only gets recognized on the balance sheet if it's probable that future economic benefits are going to flow to the entity and the cost of the item can be measured reliably. If you can't guarantee it's going to bring in value or you can't accurately put a price on it, it doesn't make the cut.
Now, this is actually kind of wild. Check out this rather quirky inclusion in the standard, the bearer plant. A bearer plant is a living plant used to supply agricultural produce over multiple periods. So think of a grapevine in a vineyard or an apple orchard. Because these plants act as a sort of permanent machine for producing goods, rather than being the actual crop that gets chopped down and sold, IAS 16 treats them just like machinery. So yes, thanks to IAS 16, a living, breathing apple tree technically follows the exact same equipment rules as our multi-million-dollar jumbo jet.
Moving on to Section 2, calculating the initial cost. Day 1 of the asset's life.
Okay, so day 1. Our airline just bought that brand new jet. What actually makes it into the cost bucket on the balance sheet? The standard is incredibly specific here. You've got your allowable costs, obviously the purchase price, non-refundable taxes, delivery, installation, even the initial estimate of dismantling the thing later on. Basically, any costs directly tied to getting that plane ready to fly. But look at the forbidden costs. Let's say the airline throws a massive, lavish opening party to celebrate the new plane, or they run a huge ad campaign, or train the flight crew. Yeah, none of that counts. Those are just everyday business expenses, not asset costs.
But what about year 2 or year 3 when we actually need to maintain the plane? Well, IAS 16 makes a very clear distinction for subsequent costs. Day-to-day servicing, routine oil changes, cleaning, minor part replacements, that goes straight to profit or loss as an expense. However, commercial aircraft require these mandatory major fuselage inspections every few years just to keep flying safely. Because that major inspection provides future economic benefit by extending the plane's life, that cost gets capitalized. It's added straight to the asset's carrying value on the balance sheet, while the cost of the previous inspection is derecognized.
All right, Section 3, cost vs. revaluation models. The working years. As we enter the working years of our asset, we hit a massive fork in the road. A company has to choose one of two models as an accounting policy and stick to it. The cost model is your traditional route. The asset is carried at its historical cost, minus any accumulated depreciation and impairment over time. It's safe, it's stable, it's predictable. But then we have the revaluation model. Here, if the fair value can be measured reliably, the asset is carried at its revalued amount, essentially its current market value, minus subsequent depreciation. This keeps the balance sheet highly relevant to current market conditions, but as you can imagine, it definitely introduces some volatility.
Now, if a company does choose the revaluation model, there is a super strict rule they have to follow. If one item is revalued, the entire class to which that asset belongs must be revalued simultaneously. This is purely to prevent manipulation. Our airline can't just cherry-pick the specific airplanes that went up in value to make their books look amazing while quietly ignoring the ones that lost value. Nope, it is all or nothing for that entire class of assets.
The accounting mechanics behind this reevaluation are actually pretty fascinating, honestly. If our airplane's value goes up, that gain isn't treated as normal income. Instead, it's recognized in other comprehensive income and parked over in equity under a revaluation surplus. IAS 16 really doesn't want companies artificially inflating their standard profits with paper gains. But, and this is a big but, if the airplane's value drops below its historical cost, that loss hits profit or loss immediately. So the standard treats gains super cautiously, but punishes losses right away to make sure investors are never misled by overvalued assets.
Section 4. The rules of depreciation. Accounting for wear and tear. As that plane flies across the globe, racking up millions of miles, it wears down, obviously. We capture that declining value through depreciation, which is just the systematic allocation of the asset's depreciable amount over its useful life. And this clock starts the exact moment the asset is available for use, basically when it's in the location and condition necessary to operate. Now here's the kicker. Depreciation doesn't just stop because the plane is parked in a hangar during a slow travel season. Unless the asset is fully depreciated or officially classified as held for sale, that depreciation clock just keeps ticking. Because commercial obsolescence and physical aging, yeah, they happen even when an asset is just sitting there idle.
To do this right, IAS 16 requires this brilliantly logical method called the component approach. You don't just depreciate the airplane as one giant single block. You break it down. You identify parts that have a significant cost and different useful lives, and you depreciate them completely separately. Think about it. The main airframe might last 20 years, right? But those massive jet engines, they might wear out and need replacing every 5 years. The interior seats? Maybe every 3 years. The component approach makes sure the financial statements actually reflect the true physical consumption of each distinct piece of the asset.
Oh, and this is absolutely crucial. You cannot base your depreciation method on revenue. Why? Because depreciation has to reflect the physical wear and tear or technical obsolescence of the asset itself. Fluctuating airline ticket sales, inflation, or a sudden revenue spike from a killer marketing campaign, that has absolutely nothing to do with how fast those jet engines are physically degrading. The method has to be tied to the asset's consumption, not the cash register.
Finally, Section 5, Derecognition and Disclosures. Saying goodbye.
Eventually, all good things gotta come to an end, right? An asset is officially derecognized, meaning it's completely wiped off the balance sheet, under 2 conditions. First, on disposal, like if our airline sells the old plane off to a cargo company. Second, when no future economic benefits are expected from its use or disposal, meaning the plane is totally retired, dismantled, or just destroyed. When this happens, you calculate the gain or loss by taking the net disposal proceeds and subtracting the carrying amount. And remember this golden rule of IAS 16, that resulting gain is strictly classified as a gain on disposal, never as revenue. Revenue is for your core business operations, not for selling off your old equipment.
Finally, we arrive at the fine print, the disclosures companies must reveal in their financial statements. They have to detail their measurement bases, their depreciation methods, useful lives, and provide a full, detailed reconciliation of every single addition, disposal, and revaluation from the beginning to the end of the period. They even have to disclose if the assets are pledged as security for loans. Why does all this matter? Because investors literally need this transparency. They have to read the notes to the financial statements to know if a company's billion-dollar fleet of airplanes is real, well-maintained, and accurately valued, or just some mirage on paper.
So, I'll leave you with this. The next time you look at a company's balance sheet, are you just going to see a static, boring number? Or will you see a living history of costs, meticulous reevaluations, and the ongoing story of physical wear and tear? IAS 16 is what breathes life, structure, and reality into physical assets. It turns steel, glass, and, well, apple trees into a language investors can actually trust. Thanks for joining me for this explainer, and keep that curiosity sharp as you decode the financial world around you.